Hi, my name is Jame DiBiasio. I'm with AsianInvestor. With me is Jim Veneau, who is with the Fixed Income Group at AXA Investment Managers based in Hong Kong. Jim, you've talked before about the improved returns that you can get from Asia high yield versus US high yield. What explains that and how sustainable is that?
The simplest explanation for it is that you're getting a considerable spread premium over US high yield. We've done further analysis where we adjust that for credit losses. So we assume historical default rates and loss given default or recovery rates. And by doing that, we see that even on a credit risk adjusted or credit loss adjusted basis, you're still getting superior returns out of Asian high yield, especially the risky cohorts like single B.
Is that sustainable? Is this going to last?
It's sustainable so long as there continues to be a correlation in default rates between regions, and so far, or over long periods of time, there is. In fact, if you do it on a regional basis, Asia tends to have lower defaults than more developed markets, and that's just because of the risk composition of those respective high yield markets. For example, the US high yield market is made up 56% single B or lower. In fact, it's 17% triple C, whereas Asia is 28% single B or low, only 2% at triple C.
Does that difference in composition explain this extra return that you get from Asia, or is that only one part of the story? Why do we have this divergence?
No, it doesn't explain it. In fact, the only major difference we saw when we started comparing ratings at the cohort level was that there was a little more rating volatility. And if we use ratings as a proxy for credit risk, then we'd assume that there's a little more credit volatility in Asia at the risky levels, at single B and triple C. But we're also finding that there's more of a positive rating drift. So what will end up happening is that your jump to default risk might be a little bit higher. So your one-year default rate for a single B is 5.2% in Asia versus 3.5% in the US. But you're twice as likely at the single B level to be upgraded to double B. So what that means is as you accumulate defaults, so if you do a longer-term cumulative default rate, say 5-year period, then the cumulative default rates tend to balance out.
How much of the Asian high yield space is from China? What kind of companies from China, and is that going to be an issue given some of the, I guess, the macro question marks that people have about Chinese growth and sustainability?
As we speak right now, it's substantially China. It's I shouldn't say substantially. It's the largest chunk or proportion is in China. It's about 40%, but that's constantly evolving. If we go back 4 or 5 years ago, this was a majority sovereign market because you had Indonesia and the Philippines as high-yield issuers. They've been upgraded to investment grade. Now the high-yield market is 80% corporate, and right now it is very much tilted in the direction of China. But that can and we do expect that it will evolve as India becomes potentially a much bigger issuer in this space. Right now, India is only 9%. They've been kept out of the market for structural and regulatory reasons. If that's eased, they could be a much bigger part and balance out the China.
Do you think that easing is going to come with the new administration? Is that likely?
I do. I don't know how much of an impact it will have or over what period of time, but I do expect that. We've already seen some test issuance, so to speak.
Do you see a bond connect? Do you see a way for the Chinese local currency story to become more widely available?
It's not confirmed, but it seems like a logical extension. And even right now, the combination of QFII and RQFII licenses or quotas have expanded very significantly, and in fact the markets they're available in, I believe, is up to 7 now. If you combine QFII and RQFII capacity, it's over $1 trillion. So that does give investors potential access to the onshore market or potential significant access to it, but the game changer will be a bond connect.
Okay, thank you for your time.
Well.